Welcome back to another video. My name is Timothy and on this channel speak everything personal finance. In today's video, I'm going to talk about why we cannot panic when it comes to being an investor. Over the last few days, the market has been down, really down. I lost maybe $1,500, $2,000 because I don't have that much invested right now. Of course, I'm only 29. I am not panicking, and you shouldn't either. Investors, especially people that just started investing, young investors, there's no need to panic, especially when the market dips, because this is just all part of the cycle of being an investor. I didn't personally go through what happened in 2008, 2009. I personally never went through a huge drop in the market, recession type drop in the market. I've never went through that. But I know that eventually I will be going through that, and I will not panic. The thing I will continue to do is invest into the market, because there's going to be the ebbs and flows of the market. So over the past few days, the market has been really down. Now today, at this time, it's only 11 o'clock in the morning, but on February 6th, right now, the market is back up. So say yesterday I lost $500. Today, right now, I've gained $500. Still, the day before I lost like $500 something as well, but it's coming back up. So this is why you don't exit, because someone might have exited. They saw they lose all this money, then they exited, and then the next day, they might gain it all back or gain half of it back. So we do not panic when the market dips, because we're long-term investors. What exactly is a long-term investor? To me, a long-term investor is someone who's gonna be investing 5, 10, 15, 20 plus years. There's no need to panic. Now, if we were in maybe our 50s or our 60s and we had all our money really invested into these kind of high growth funds, whether it's the S&P 500, whatever kind of company you want to invest into, we're at a higher age and the market started dipping like it is, we have this big lump sum of money invested, then maybe we want to start thinking about de-risking our portfolio. But when we're in our 20s and we're investing for 20 plus years, I have 20 plus years of investing. So when the market dips, it doesn't bother me. I know that the stock market is meant to build your wealth. You're meant to make money from the stock market. That's why people do it. If the stock market was meant to not build your wealth, then people would not invest in the stock market. The best investors would not invest in the stock market, but it's there to build your wealth. So I'm going to continue to invest. I'm going to continue to dollar cost average into the market, which is basically setting up some kind of schedule, whether that's daily, whether that's monthly or weekly, that you're investing your money, contributing your dollars into the market. That's dollar cost averaging. I'm going to continue to contribute my dollars to my 401k, continue to contribute my dollars to my Roth IRA. I don't do the brokerage account anymore, but I'm going to continue to invest my dollars every single month. I'm not going to change the amount of money that's going in. I'm not going to add, I'm not going to subtract. I'm not going to go buy some random stock and bet that it falls or bet that it rises. I'm going to continue to dollar cost average the market, because I know that's the best way to build wealth. And I plan on retiring in about 20 years. So I need to be sure that I'm continually putting the same amount of money to the market, if not more, into the funds that I believe in, which majority of my money is put into the S&P 500, into VOO or FX, AIX, or just into my 401k, and invest it into whatever fund is similar to the S&P 500. It's the biggest reason why we don't set our returns at 8% or 10%, or we can set them at 8, but we don't set them at 12% or 15%, because that's not realistic. The reality is we have to expect for dips to happen in the market. We have to factor in inflation. We have to factor in all these different things. This is why when we're doing projections or how much our accounts are going to be, we use 7%, because every year it's not going to be that 20% number that we had a few years ago. Every year it's not going to be 10%. So you get a return from the S&P 500 of 10% for 1 year. The next year it might be 5%. Then the next year after that might be 8%. The next year after that might be 6%. So we just go with that 7%. It's a conservative number to use when you're projecting how much of return you're going to get from investing into the markets. Honestly, the best time to start investing is when the market is in a dip. That's when stocks are cheaper. So you want to actually invest at that time. So just continue to invest. Don't pay attention to the dips, especially if you're a long-term investor like me. You have plenty of years to invest. We are not worried about when the market crashes or if the market's dipping. Whatever, it's whatever. You continue to invest, because we are on a journey for financial freedom, and we're going to get there. We're going to have so many more dips, so many more crashes in your investing career. And to be honest, like I said, I've only been investing for maybe 5 years. So I haven't seen too many dips, but I know over the rest of the years I'll be investing for 20 plus years, it's going to happen. and I'm gonna be prepared. I'm gonna continue to invest monthly into my accounts. So let me know what you guys think about that. Are you continually investing even when the market dips, or are you pulling all your money out? Are you locking in your losses? Are you trying to preserve your money and store it in cash and then put it back in when the market's more stable? What are you doing with your money? Hopefully you're investing. Hopefully your dollar cost averaging to the market every single month, no matter what's happening. So hopefully you guys enjoyed the video. If you did, leave a like, subscribe to my channel, and I'll see you guys in the next video.